So I have been talking about ACG manufacturing lines, actually, sorry, high-speed manufacturing lines. So let's delve deep into it. ACG with 50% market share is driven by higher capacity machines, which are more efficient and having higher cash flows. ACG's fastest machine has 4 million capsules per day capacity. NatCap's production line before 2020 was fuel guzzling, same as 25% of the cost, slow. It was having only I think only 1.5 million capsules per day capacity, and manpower intensive. What NatCap needed, because we were talking about strengthening the capsule business, right? So what NatCap did really is it went to a Pune-based robotics company called DBDS Robotics Design Company. Together, jointly collaborated and built a new machine, which was produced jointly with them. The license is held by Natural Capsules. So DBDS cannot really go together and sell it to another third person. And this capsule manufacturing line was both high speed, efficient, and automated. And automation really means that basically, manpower intensity was low. It was 3x faster than its previous line. So initially it was 1.5 capsules per day, million capsules per day. Today it is 5 million capsules per day per line, and more than ACG's 4 million capsules per day capacity. One zinger over here. NatCap is also experimenting with 7.5 million capsules per day machines. So it's very much possible that you can see that the last, so basically it can be like this, that Q4 2022 saw 5 million capsules per day installation one. Q1 saw 5 million. Q4 will see 2 5 million and 1 7.5 million possible, because alternatively management is writing 22 billion capsules per annum kind of figure in its presentation, but talking about 24 billion capsules per annum. So depends. I don't know.
Tom, I'll just interrupt for a second.
Yeah.
So you mentioned million tons.
Million capsules per day. So there are two metrics over here. MCPD, million capsules per day, and billion capsules per annum.
I think once you said million tons, so that is where.
Sorry, no ton. Then no ton over here. Sorry for that. If I did say that, it was a mistake from my side. So it's MCPD or BCPA. MCPD or BCPA. That's it. Million capsules per day or billion capsules per annum. Yeah.
Sure. Please go
million
ahead.
ton. If million ton, I was saying for APIs.
So million ton API.
Sorry. I'm sorry for that. Yeah. It was a mistake on my side. It is not million ton, it's metric ton. Sorry for that.
Metric ton, right?
Yeah, it was a metric ton. We are importing 19 metric ton, not million ton. Sorry for that confusion. 19 metric ton, 20 metric ton, 39 metric ton.
Okay, please go ahead.
Yeah. Thank you for that, Ankit. Yeah, thank you for that. Yeah. So as a result, when the new capacity came up, its electricity cost came down by 40%. Its manpower intensity dipped by 36%. And modern machinery, implied that the rejection rate came down to 8% to 3% actually. Someone was asking that, can the reject ratio be reduced? Yes, this is how the reject ratio was reduced. In fact, we were talking about the margins, erratic margins, but this is it. And this is what basically the proof of the pudding is. Ankit ji, you will have to tell me whether you can see the faded purple or whatever it is, faded bar over here on the chart.
First line of new machine setup. That is what you're asking about?
Yeah. So you can see, do you see any region over here, shaded region over here?
Yeah, I can see that.
Oh, okay. So it is supposed to be shaded region. It is not supposed to be a bar per se. Basically, the idea is, I think the first, by FY20 end, or rather FY20, the first line of new machines was set up. And you can see this thing that basically the capacity actually increased. So it was about 7.5, 7.1 million, sorry, 7.1 billion capsules per annum, which kind of increased 7.8 billion capsules per annum, because one obsolete machine line was kind of replaced and changed with a new capsule, this thing. So from there, basically, it kind of kept moving, and this is the projected one. And we have seen a kind of a fall in the employee cost as well as the power and fuel cost. So the power and fuel is the red line, and the employee cost is the blue line. So it started. So 2013, it was 12%. Today it is 9%. The power and fuel, that is. Employee cost was 8% in 2013. It was 7% today. So the overall idea is this thing that it is the cost structure is improving. So let us dive into the numbers. I hope that you do not really get intimidated by so much numbers. Basically, the idea here is this thing that what we are trying to measure is this, that how much capital expenditure it is making net of depreciation, and that we are kind of thinking it as the incremental fixed capital investment, incremental investment in its capacity, and we are kind of checking it with the increase in the sales, and we are kind of trying to figure out that is the business getting efficient in converting fixed asset to growth. So change in fixed asset, if it's $100, is it leading to more than $100 worth of this thing, worth of revenue? So what we saw in FY19, that 78 paisa of extra fixed asset investment was required to generate 1 rupee of extra sales. In FY22, it fell down to 43 paisa. So this basically tells that it is not really only becoming cost structure efficient, but also efficient in converting extra investments into revenues. And that translates also into its ROE numbers. Why? Because ROE implies return on equity. What does equity mean? But rather investment of investment, or rather ROA numbers. And what does A mean? Its own investment. What is the return on it? Or how much more efficient it is in converting its assets into returns. We are seeing that basically it has become kind of 2x more efficient. I mean, roughly 78% to 43%.